Awesome. So thank you guys so much for joining. It's a pleasure to meet all of you in person. I'm gonna be sharing my screen with you, so I won't be able to see you so much. But the first thing I just wanted to do was introduce myself. My name is Elijah.orozco, Fresno. I currently am residing full-time in San Diego, and I'm in Fresno part-time once a month where I live in Fig Garden. So a little bit of background on me. I am from Duncan Poly, where I was majoring in farming. So I have an agricultural background. That's where I started. And it was in 1995 that I found out I'm not inheriting any of my family's land. So I switched to banking. And so I've been in banking ever since. I switched from there working for a CPA, working for a financial planner. And then in 2005 is when I switched back into the industry. If you don't already know, I am going to be hosting a seminar this Tuesday, and I would love for you guys to be able to participate, whether it's via Zoom or in person. You're all welcome to join. If you haven't already connected with me, please do so on social media, especially if in the future we are going to give you leads. It's nice for you to be able to have access to the advertisements. I would love for you to share in advertising, but I can only do that if you're following me on social media. That's just how our social media advertisements work. I do share these on 20 different platforms, including Google, Facebook, Instagram, Eventbrite, and it has tremendous success. So we already have about 50 people who have signed up for this event, and I am trying to keep it small. I've had as many as 200 people sign up, and so we can turn up the volume as needed. I did give you guys all a workbook so that you have the ability to reach out to me and my staff. One of the biggest complaints in the industry is that it's so difficult to be able to get hold of a loan officer. And for example, right now I'm going to be unavailable for the next hour. So if anyone is trying to call me right now, I won't answer the phone, but I always like to have someone that can answer. So if you look on the second page of the workbooks that I gave you, you do have my staff on there with all of our phone numbers so that you can be able to reach all of us. So the main contact is myself. That's why I'm in orange. I'm the owner of Team Orozco. And then I have two current licensed loan officers dedicated to me, David and Max. Emily, she's my executive assistant. She's also still in school. She's a Harvard student. I love her to death, just a big brain, love having her. And then I have my team captain, Bree. You can always get a hold of any of us, so you never have that frustration of where are you in a file. If you have a hot lead, that we want someone to always be able to reach out to us, okay? So that is who we are. In 2005, I partnered with Scott Evans. We're one of the top 10 loan officers in the country in terms of volume. Scott is the #1 loan officer team in CrossCountry Mortgage. We have branches throughout all of America, and we are the #1 producing team within our bank. Our own little team, we actually have been fortunate to be the #1 VA lender nationwide compared to all banks and other loan officer teams for the last 4 years. And it just kind of happened on accident. We're based in San Diego, and it's the only city in the US that has all 6 branches of the military there. So that is one of our specialties. A lot of great things that we could do for vets out there, get really creative. And a lot of times, because we are the #1 volume producing VA lender in the country, when VA has an experimental loan product, we're the ones that they reach out to try it. So for example, VA right now is working with us on construction loans. We can use VA financing to purchase a home and finance 100% of the construction. Since we partnered in 2005, we've helped over 20,000 families. And I don't say that to impress you, I say that to impress upon you that when it comes to home loans, we definitely know what we're doing. There's 986 different loan programs in this beautiful state of California, and we know just about all of them. We don't use all of them, but there's just a lot of loan products we have for your families. Cool. Any questions so far? I have a lot of information, so I'm going to go pretty quick.
Yeah, I'd like to jump in there really quick there, Elijah. Thank you everybody for coming. It was this is Elijah. He's with CrossCountry Mortgage. One of the things that I do on a weekly basis is have an opportunity for all of my mentees and people within our organization to come in and learn from loan officers and escrow officers like Elijah. And so this is really an opportunity for us to ask questions about everything that he is presenting as far as his own products, but then also we're going to do a deep dive into that, all of the market trends that they're seeing. And because his organization has access to national data down to the local data, he has some really interesting charts and conversations that we can have with our clients. So thank you guys very much for joining us today. Elijah, I'd love to drop it back to you. I know that there's going to be questions coming in. If you guys can just drop them in the chat, I'll happily read them when we get to our Q&A time. So with that, just kind of some rules of the road. Drop the questions in the chat, and we'll get to them as opportunities arise. So go for it, my friend.
Awesome, thank you for that. So one thing that I do, hopefully you guys can see my slide. If you do have a workbook or a blank sheet of paper, one thing that I like to do with all my clients is do this 4 phases of financial wealth. One thing that I do as a lender is I help people get into the largest debt of their lives. And one thing that I like to do because of that is try to help them get out of it. And most people don't know.
450, you'll meet with Hector.
Oh, yes.
Joe,
Yeah.
can you mute your phone, please? Or your Zoom, please. So one of the biggest challenges is that a lot of people have money, they work really hard. We live in the wealthiest country on the planet. And out of all 50 states, we live in the wealthiest state, but it doesn't always feel that way. As real estate agents, you guys have something really unique. As long as you have your real estate license, this is something you can verify with your CPA. If you buy an investment property, you're able to claim 60% depreciation immediately as a real estate agent. That's a great way to be able to avoid paying a ton of taxes. So we always try to help our real estate partners purchase at least one investment property throughout the US. So if you think you're gonna make $100,000 gross, well, if you were able to buy a $150,000 investment anywhere in the US, well, you can depreciate 110,000. So you would actually be able to have 0 taxes, 0 liability, which in turn, when you're purchasing a home, because it's depreciation, we can give it back to you to have you qualify fully at 110%, 100% of what you made. So that's just one of the tips and tricks that we have for our clients that go my way. This is the chart that I go with them based on the industry that they're in. But you really can't build wealth in this country unless you start with a home. You definitely need to own your own home. For those of our W-2 employee borrowers, we tell them to max out their 401k. Maxing out their 401k will give them $1 million in 20 years. And that same 401k, they can take a loan against it, not a cash withdrawal. We don't ever want withdrawals out of 401ks, but they can take a loan against it for a triple tax deduction. Just doing those 2 things will make them a multimillionaire in the next 20 years. And these are really simple things. We get emotional often with money, but these are tactics that are logical, they're easy, and they make sense. Once our homeowners they bought their house, they max out their 401k, we want them to open up a money market. But you don't do a money market till you paid off all of your credit card debt. You don't have any cars. With cars, we get into trouble. One thing that's really great about you guys is you can also claim 100% depreciation on cars that you buy that are over 5,000 pounds. That's unique, and there's a difference between a deduction and a depreciation. Anyone know what's the difference between that when you're doing your taxes and the difference between a deduction and depreciation? Any guesses? One of the biggest thing is that with depreciation, it's a number that we can give back to you to qualify. So for example, if you have a $100,000 deduction, it's great because you don't have to pay that in taxes, but then it doesn't look like you really qualify for anything when trying to get a loan. With depreciation, we give 100% of depreciation back to you, which then makes it easier for you to be able to qualify. So that's where a lot of people in our industry get into trouble, is we have to get creative with our taxes, and sometimes it can backfire when we're trying to get into a home. So using these little tactics can be really beneficial. So that's one of the things that we share with homeowners. We also like to tell people not to buy anything that's brand new. If you buy a car, it should be 2 years or older. If you do buy something brand new, you want to hold on to it for 8 to 9 years, and then we go into stock. So that's just one of the things that differentiates me from a lot of lenders that are out there, is I teach people on a one-on-one level based on their tax returns, pay stubs, what is it that they have going on, short-term and long-term goals, how to start building wealth. And that's one of the things that I'll be going into more detail in our seminar next week. Anyone want to guess, where do interest rates come from?
I have no guesses for you, sorry.
Thank you for that. So they actually come from Wall Street. they come from Wall Street. A lot of people think that they come from the Federal Reserve or they come from banks. As banks, we all have access to the exact same interest rates. So the lowest we ever had interest rates in US history was December 2020. That was the lowest rate ever had interest rates, December 2020. A VA, FHA, USDA loan was 2.25%. At the 1 point buy down, it was 1.99% for a 30-year fixed. Crazy, right? Conventional loans is 2.5%. Every month since then, for the last 16 months, interest rates have been going up every single month because there's only one thing that can make interest rates go up, and that's inflation. We've been hearing a ton of talk about inflation, right? So the good news is we did know that this was going to happen. We also knew that they were going to peak this summer. It looks like with what's happening with the Russia-Ukraine war, that things are accelerating a bit and rates should actually start dropping even sooner. So that's one of the benefits of using someone like myself, is that we're able to predict with the help of these statistics what's going to happen. I have a question about the difference between a mortgage broker and a typical loan officer. Oh, good question. Brian, if you want to clarify what you mean by that, I'll be more than happy to answer that. But one of the benefits about having numbers like this is educating consumers. How many people are out there concerned and scared that they don't want to buy something because they think that, one, either the market's going to crash or that interest rates are going to keep going up? We do know that interest rates are going to drop at the end of the year. So all they need to do is make 6 payments. And then after that, we'll be able to get them into something lower in the next 6 months. How do we know that? I think it's probably maybe too much information at this point. I'll be more than happy to do that in a separate slide about what's going to happen with the market. But we do know that interest rates are going to go down this year. And then at the end of 2023, beginning of 2024, rates should drop lower than where they were when they peaked in December 2020, which means that we expect government loans to go back down to 2.125% in 24 to 36 months. So knowing these kind of things helps people to get off those sidelines. We just need to get you into the game, because you know how hard it is to get into a house right now, right? So education is very key to me. It's important that I'm educating consumers, and that in a state of chaos, because our world market is in chaos right now, that they have a rock solid foundation like myself to help steer them through the chaos and get them into a home.
Can I derail you for a second, Elijah? And can you actually dive quick into, you know, when you're saying end of the year, a lot of us are working on that, you know, that cycle of like, we're helping buyers get ready to be purchasing, we're giving advice. What should we be watching coming into the end of the year piece that you mentioned there? To knowing that, you know, rates are going to go back down.
Oh, that's a great question. So what caused all of the rates to go up was the $1 trillion stimulus package that went out in January 2021. Whenever we have a large stimulus package go out like that, historically over the last 60 years, when you look at every capitalist country, you have the same pattern that happens every single time. And that's that you have inflation. This creates short-term inflation, and short-term inflation, any type of inflation is always going to just create an increase in interest rates. So that's the not so great news. The good news is when you look at the same pattern, historically over the last 60 years, every time you've had a large stimulus package, this is the largest we've ever had in US history, then they end up going lower than when they peaked. That peak was December 2020, January 2021, they started going up every time. And it takes 12 to 36 months for it to go down. $1 trillion is a lot of money to spend through. Once the euphoria of all that spending does go away, then you end up having deflation happen on its own. But what ends up accelerating it is when you have the Federal Reserve that steps in and they raise the fund rate to kind of help battle inflation. Then the repercussion of that is it does trigger a recession. We know that we're going to go into a recession this year. We're going to see a 10% decline in stocks. But it's just also knowing what's going to happen. If you know that stocks are going to go down to 10%, well, it's a great time to buy stocks. They're going to be on sale. Same thing with homes. We know that homes are going to keep going up in home prices. I like to think of it as being on sale. The prices you see right now on these homes, you're never going to be able to see again. So one of the things that we have is a software that tells people if you bid over asking, how much is your home going to be worth in 3 months, 6 months, a year? Because a lot of times you bid above asking, but by the time you close escrow, sometimes it's already worth what you pay for it, even if it came in under appraised value. I don't even know if I answered your question. I just went off on a tangent.
I believe it's a brilliant tangent. And I do want to kind of pause here, because I know that's what a lot of people are popping into this call for, is that kind of value that you just, you know, tossed at us. So does anybody have a follow-up question to that? Because I know that that's why a number of you are here and what we were talking about before. So, Kristen.
I do. So is that just a product that like CCM offers or just your team, or how would I get my hands on something like that to help with my clients?
So it is something that is proprietary to us, and we give
Okay.
it individualized to every consumer that goes our way. I mean, it's really overwhelming. And so we have different ways to break it down to make it as simple as possible. But something very interesting did happen today, and that was that the Federal Reserve did raise the rate 0.25%. And the market, I mean, it's something that if you saw my forecast in January, I did say that we were expecting that the Federal Reserve was going to raise their rate. Just happened sooner than I thought. I thought it was going to be closer to June, July. But what's happening with the geopolitical system overseas, it got accelerated. And we see that the Federal Reserve rate is going to go up 7 times. How is that going to affect us? Whenever the Federal Reserve raises interest rates, it always has the exact same thing happen. It happened in 1989, it happened in 1999. And here we're experiencing again in 2022. We're really in a similar economy. It's a pattern that you can see what happens. Whenever the Federal Reserve raises their interest rate, the Federal Reserve rate, it makes money more expensive. That slows down the economy and it creates deflation. Deflation is a beautiful, magical word for interest rates because it means that interest rates are going to go down. Now, they said that's going to happen 7 times over the next year, so it is going to be gradual. Every time they lower their Federal Reserve rate, we expect interest rates to drop. So rates have gone all the way into the 4s. We expect them to go back down into the 3s, possibly high 2s by the end of the year. Any other questions? Hope I answered your question.
Brilliant.
Yeah, that's very helpful.
Awesome. So let's keep going. So let me just go back to that chart that I shared with you. And as a bank, all banks have access to the same rate. So really, as a lender, we're pretty competitive because we all have access to the same things, right? Today is probably one of the worst days to lock a loan just because the market got spooked. But we had some after hours trading and it's already starting to recover. This is the last 2-year trend. And when you see the value of a mortgage-backed security, you see right here on March, this is where the market ended today and it's lost a lot of its value, right? It works inversely. When a mortgage-backed security or a mortgage bond loses its value, the effect of that is that interest rates go up. So you can see that from that peak in December 2020, rates have lost their value ever since, and they've been going down. But it looks like we have bottomed out today. We already have seen that the market is starting to recover. You'll see that stocks continue to tumble. But also, usually whenever you see stocks go down, that's good news for interest rates because investors are going to take money out of stocks. They want something conservative, something safe, something secure, and they buy mortgage-backed securities. They buy government bonds. And that just makes interest rates further go down. So this is going to be compounded as the year progresses. Not necessarily the greatest news because our market doesn't need more buyers. We need more sellers, right? But this is indicative of what's going to happen. We are going to see buyers getting a little more excited. You're probably going to see some canceled transactions over the next couple of weeks because people who were approved in those rates in the 2s and maybe are getting something in the 4s, they're going to panic and they're going to cancel. So I don't know if you guys have already seen some cancellations, but across the country, it's something that we are observing. So that's all I have about interest rates for today. I'm going to keep going unless you have any other questions.
Anyone else?
So another hot topic is, are we in a housing bubble? What do you guys think? Anyone think that we are in a housing bubble? It's something that comes up all the time with consumers. And most of us who are in the industry, we know there's no way we're in a housing bubble, but it's hard to convince a consumer that we're not, right? So what can we tell them? You're more than welcome to take screenshots of anything that I'm sharing with you today to share with your buyers and your sellers. So it's important to know what a housing bubble is. The last 2 we had was in 2007 and 1989. And when you look at this chart, you see that it was, you came at a peak. You just had a ton of inventory. And you look to where we are now, we're at a valley. It's the complete opposite of what a bubble looks like, right? And let's explore that just a little bit further. So if we look at the last bubble, which was in 2007, we had 3.7 million homebuyers at that time. And there was only, I said that backwards, 3.7 million listings, and there was only 1 million buyers. So if we had 1 million buyers and 4 million listings, well, you know, supply and demand, the market crashed. Well, you look at when I started doing this last year, we had 1.28 million homes, January 2021, and 4 million buyers. Well, when I started this again in January 2022, we have now 6 million buyers and 910,000 homes for sale. There's no way that we're in a housing bubble, right? Numbers don't lie. People lie all the time, but numbers don't. That's one of the things I love about my job. So because of this, there's really only one solution. If you have 6 million buyers, you need to build 6 million houses. But just with what's happening, that's not going to happen anytime soon. Something that kind of aggravates this situation is millennials. We all keep hearing about millennials, and we're not blaming them, but it is a reality that first-time home buyers are what's driving a market. And when you look at what happened in 2006, the number of people that were born every year actually decreased every year for the next 5 years. So that means in 2007, you actually had less and less home buyers every year. And that's why it was such a deep crash. Well, we actually have the opposite right now. From 1989, that's the average home buyer today. And when you look at over the next 5 years, the number of births increased every single year and actually never goes down below 1989 numbers for the next 10 years. So that just means that for the next 5 years, we're going to have more and more home buyers every single year. Again, not great news if you're a buyer, because you're going to have more and more competition. What made this even more aggravated is that when we had the shutdown, construction nearly came to a standstill. So we had the last decade, slowly new construction was starting to recover, and then it stopped pretty much in 2020. Now, fortunately, like construction's on fire again, but they actually have made announcements in October. KB Homes and Pardee Homes, they both made announcements that they're going to actually slow down their construction because they're having homes built, but buyers can't move into them because there's a shortage in appliances because of chip shortage. So all these problems are just making this market a housing crisis. So I like to share these with consumers because it shows what's going to happen with the market. Any questions on housing bubble? Everyone satisfied? We're on the same page. Good. So one of the things that is a good reason why to buy a property is appreciation. We know as real estate investors that one of the great things about buying a home is that the value is going to continue to go up. So the last 5 years, home prices have gone up 8%, last decade 7%. Historically, Fresno County has appreciated at 5%. And that's one of the top 10% of the markets in the country. So the Central Valley is actually considered one of the top 10% of the market in the country, which is great news. Now, we're not going to see those double-digit appreciation like we were seeing in a lot of neighborhoods. It looks like it is going to be closer to 6 or 7%. But over the next 5 years, home prices are going to be 30% more. What does that mean? Well, here in Fresno, this is county prices. The median home price in Fresno is $362,000, and San Luis Obispo is $739,000. Now, this is as a county. You can find homes cheaper than that, obviously way more expensive, but this is as a county. A lot of people see these numbers and I think there's no way anyone can afford this. Well, here in San Diego, we're at 760, Orange County, 950,000. I also do these seminars in San Jose where it's now a whopping 1.5 million. And remember, these are entry-level homes. This is the same looking house that you'll see. And in San Francisco, it's 1.7 for a studio. I mean, it's really crazy where home prices are going, right? But I like to break it down even further because, you know, when you look at neighborhoods specifically, you start seeing big changes. So the city of Fresno is closer to 359. Clovis is, I mean, a really gigantic increase because the schools are just so much stronger. You have a lot more things happening in Clovis that is a safer area. Old Fig Garden, 637,000. A lot of $1 million homes out there, obviously. Los Osos is one of the more affordable areas in SLO County. San Luis Obispo, nearly $1 million. Pismo Beach, 1.2 million. And a lot of people, they see these numbers and they're just like, well, there's no way that anyone could afford this. But you know, we have with as many home buyers as we're seeing, we know that home prices are going to keep going up. So this is the forecast for Fresno County. If you guys would like a copy of these for any county, I'll be more than happy to give you one. If you want a co-brand, we could do that as well. I think it costs like $20 a year, and you can have all of your information on here. Just if that's something that sounds good to you, you can send me an email and I'll be more than happy to add you to this. So let's look at this data even further. That means that the median home price for a Fresno County home right now is going to go up 110,000. I think that's really important because if you're a home buyer and you're waiting for home prices to go down, you might end up pricing yourself out of the market and never be able to buy. We've all studied in history that there's been economies that really separated the haves and the have-nots. And then a lot of times people I wish I did at that time. We're in that economy now. The people who are able to get into a home, you're going to see a very dramatic shift in wealth. And people that don't end up getting into a home, unfortunately, may never be able to do that now. So knowing that homes are going to go up another $100,000, it absolutely makes sense to get into a property now. So if we go back to Economics 101, we know that it simply comes down to supply and demand. I have this data on just about every county. I would say 98% of the counties in America. And a lot of these numbers, they change about every 6 months. So this is the economic data for Fresno County. There's basically about 1 million people who live there, half own, half rent. Now, what's interesting is that out of that 500,000 renters, there's over 125,000 renters that can pay nearly all cash or put a 25% down payment on the median home price. So if you have 100,000 people that can pay cash or a 25% down payment, that means that a lot of people still very, very much can afford the median home in Fresno County. And Fresno is a unique area because you have people coming from San Francisco, Los Angeles, San Diego, from even different states, because it is the most affordable California real estate. And you can get these people who are selling their $2 million homes in San Francisco paying all cash, just indicative of where the market's going to go. But there's even more so. So I told you how millennials are having a big impact. So those first-time home buyers, we have 14,000 household formations. A household formation is like a new family that they got married, they have kids, they graduate from college, and they now want to move out of their house, move out of their dorms. They're forming a new household. So those are the people we need to build homes for. Half rent, half buy. So we have about 7,000 first-time home buyers that we need to build 7,000 homes for. According to the local permits in Fresno County, we're only going to build 2,664 homes. So that means we have over a 4,000 housing shortage in Fresno County. And that's what you're seeing mostly all across the state of California. We're in one of the most difficult states to build a home in because we have so many protections. I mean, that's why our state is so beautiful. But the backfire of that is that it makes it really difficult for people to get into a home. Any questions so far? Cool, let's keep going.
This data is absolutely amazing. Thank you so much. I'm taking screenshots.
So I can keep going, but I don't know if you guys want to take a break and do a Q&A, because I will just never end. If this is too much information, I'll be more than happy to stop here and we could connect another time, or if you guys want to keep going, we can keep doing. Well, how do you guys feel?
Yeah, go for it, Brian. I think Brian has a question.
Can you hear me okay now?
Yep.
Okay, perfect. So what I love about what you just presented, the focus is on first-time home buyers, and we all know that they want to get into the game. But something I want to challenge you about is something your team sent me, and being one of the top lenders in the entire country, we really appreciate your time. And every realtor on this call, I think we invited 48 altogether, and there's 13 of them on the call at the moment, are going to have an unfair advantage when you answer this question. And the unfair advantage they're going to have is, we have in the last 3 to 5 years, the last data point that I read was about 78% of the homes in the United States have on average $158,000 of equity just sitting there. And those sellers, the biggest problem they have is they're contingent. They got to sell their home to buy the next home. And your team sent me an email about bridge loans. And the bridge loan, basically, in a nutshell, as I understand, you can give some clarity to me and everybody here, is you are allowed to borrow on the equity in your home, buy a home non-contingent, and then pay off that short-term mortgage. Talk to us about that, because we need as a group, we have San Diego here, we have the Central Coast here, we have Central Valley here. We basically have all of California covered with this group of realtors. We need to set these sellers free with the bridge loan. So spend a few minutes talking about that, because I'm very excited about this brand new product and we're on the cutting edge of it.
Thank you so much for that introduction, Brian. So yeah, we have an amazing loan product. I mean, we try to adapt to the market, and in this market, the people who have our hottest type of client is a seller. If you have someone that wants to list their home, you know that's a guaranteed sale. But one of the challenges is that a lot of home sellers, they don't want to put their home on the market. until they find another property. And that just creates an extra layer of stress on an already stressful transaction. So the way the bridge loan works is that we'll be able to take what their future equity would be up to $300,000 for their home purchase. They don't have to sell their home until they actually buy their house. And then once they have the keys to their home, they've moved in, they then have 4 to 6 months to be able to sell their property. We know that's never a challenge because these properties sell the same day you put them on the market. And then even for you as a real estate agent, having an empty vacant property is just a lot easier. One of the things that we're also doing is we are taking our files completely to underwriting. So for these sellers that they want to get into something, we are able to do 10-day closes if we can get them fully underwritten. So at that point, the only thing we need for loan docs is an appraisal and our fully executed residential purchase agreement. So one of the things that we're also doing, because there's a national appraisal shortage, is we're trying to offer 24-hour appraisals. So we'll pay a rush fee to get appraisals done and within the first 24 hours. We're actually pre-ordering appraisals the same day that escrow opens. And then once it's opened, 24-hour rush request.
That is absolutely amazing because, you know, at the end of the day, this trapped equity, people are scared to go out and buy because they know that their contingent offer won't get accepted. They're competing against cash. They're competing against people that have already sold homes. And now with this bridge loan, they actually have the ability to be competing at the same level at par. And with your appraisal ordering that fast, I tell you what, we closed, I think 15 deals so far this year, offer accepted last week, and still haven't had the appraisal. I'm pounding the lender for the appraisal. And it's been a week. And so what's going on with this? So having 24-hour appraisals and being at the level that you're performing at, I think you're going to be able to benefit a lot of sellers in a way that hasn't been done before. I would like to open up the questions for the rest of the agents here that are dealing with sellers that maybe have trapped equity and get some clarity on this bridge loan. Thank you.
Yeah, I have a question. So let's talk about bridge loan coming in, and does that make them immediately conventional? How does it couple with other lending products? Because if they say are only going to be pulling out, what was the number, Brian? Let's say 150. If they're only pulling out 150, is that contribute towards does it stack different loan products? How does that all work?
Well, that's a great question. Thank you for that. So it is available for all of our loan products. So VA, USDA, jumbo, conventional. I do have like some of the loan products that can also go into detail if you guys want. One of the hottest products that's coming into the market is forward or reverse mortgages. It has a really bad reputation because a lot of people got into trouble with that. People don't lose their homes anymore. All those things have changed. One thing that's really great about these is that when you think about how many people are qualifying, there's about 5,000 people that are becoming 62 years old every day, and they're able to buy a home without making any payments on it. So just getting really creative with consumers, educating them on what their options are. Being with VA, we also have been approved to offer a VA non-contingent transaction where it's not a bridge loan, but a lot of times when you're doing VA, you don't need a loan or a down payment. So as long as we have the person that's buying their house underwritten, we don't have to close. We can actually close on a sale of their home without closing on their listing. So just a lot of different products. We just need to know what is your needs, what is it that you need, and then we can tell you how we can make it work. Who here is in Pismo area? I know some of you guys are Fresno, some of you guys are in Pismo.
That would be, go for it.
Sorry, did you ask who's in Fresno or who's in Pismo?
Both. So who's, like, I know you
Oh.
guys are kind of all over the place.
I'm San Luis Obispo, Pismo, Morro Bay, Cayucas, all of the coastal slow regions.
One of our hot products that is available in the Central Coast is USDA. I don't know if you guys are taking advantage of that, but the #1 loan program out of all 986 products is VA, but you have to be active duty or a vet to qualify. So second best, I would say, is USDA because it also is 100% financing. It's a below market interest rate, and there's no loan limit on it. And you have a reduced mortgage insurance payment. So for example, if you are going FHA, it could say your mortgage insurance is $300, it would only be $40 with USDA. So it allows people to qualify for so much more, keep all their money in their bank account. It's an amazing loan program.
Is that on farms only, land, or is that single family residence also?
I'm so glad you asked that. It's a really good question. Just because it's named USDA, it has this connotation or this thought that it's only for farmers. And originally that's what it was for. It was created in the 60s to help farmers to be able to buy a home. But because it's considered discriminatory to only lend to farmers, now it's available to any consumer as long as it's a rural area. So I believe about 90% of the Central Valley is considered rural. So the majority of the areas out there are going to qualify. So I know in Fresno, it's just the city of Fresno and Clovis, that little cluster, and then everything else around it qualifies for it. So no, it doesn't have to be a farm.
So somebody could potentially use that for vacant land and then do something later for a building loan. Is that correct? How would
That's
that
another
work?
great question. So yes and no. So USDA is only for stick-built homes or condominiums. You do have to have something built there already, but they do have a program there. It's an experimental loan product where they are now offering construction. So it is new and it's something that's not available to everybody. You do have to have good credit and reserves in order to use that program. But yes, they are now doing construction loans where you can buy vacant land 100% financing and roll in all the construction costs. So with our FHA, VA, USDA, and conventional loan products, you can use all of those to buy usually just a property, vacant land excluded. That's a unique program with USDA, but we can finance 100% construction of a property. So if something is maybe in really bad condition, they only want cash offers, we can use this program to buy it as is, and then finance 100% of the rehab or remodel.
Hi, Elijah. This is Yue in the mostly Central Valley area. Thank you for your answers. I have a quick question back to the bridge loan. So when we try to, like as realtors, if we were to try to pre-qualify contingent buyers, are there a separate set of questions that would be helpful to ask the contingent buyers to see if they need or if they're a good fit for the bridge loan, other than, you know, if you need to sell a house in order to buy?
Yeah, there is an important question, and it's actually going to benefit you because in order for them to get underwritten, there's going to be two phases. We'll do our pre-underwriting, which will just say, okay, this is how much you qualify for, and you can use that to go to start making offers. And the next phase is actually sending it to underwriting. And one of our underwriting conditions is a fully executed listing agreement. You don't actually have to put it on the market, but we just have to have a listing agreement in place that shows they do intend to sell their home, because that's part of that's one of the big conditions, is that once they do move into their new home, they do have to sell their property. And ideally that's put on the market within the first 60 days after getting the keys to their new house. Good question, thank you.
You know, I can say that I've already sent several sellers to Elijah and his team, and we queue up properties 6 to 8 weeks in advance. And we know what's going to be happening all the way through basically July at this point. And so different sellers are at different phases, but that's a really important point that you mentioned, having a listing agreement in place. And so you can actually have a listing agreement in place up to 30 days before you actually put it on the market. In the Fresno market, it's called an authorization to exclude from marketing. And as long as you have the seller sign off on that, and say there's zero marketing, that means no text messages, no sign, no social media, zero, no telling friends for that period that you have it listed, then you'll be compliant. Don't cross that line, okay? Don't cross the line and, oh, I talk a friend. It's a, no. Make sure that you sign the authorization to exclude, and that you don't put it on the market. You don't talk to anybody until ready, set, go. A day it hits the market on the MLS, that's the day that all marketing happens. And if you follow what the Sousa Group has done, that's exactly how we handle everything when our homes hit the market. And so as we queue up people and they are becoming non-contingent, when Colleen goes out and Tim takes them out to go buy a home, they're going to buy non-contingent and then just pay the bridge loan back upon the sale of their property. And in this market, if it's advertised properly and priced properly, everybody knows it's going to sell in 30 days or less. So think quarterly as you plan for your 2022 goals and beyond.
Yeah, and I will jump in there and say on the CRMLS, the rules operate a little bit differently, and we can jump in and talk about those at another time. But Fresno is a unique scenario in as far as a county is concerned and as far as an MLS is concerned, with the ability to have that document signed and give you that permission. So with that, I think I'll close that one out to say, like, we'll lean into that, and if you want to do something like that, I will happily walk you through how to make that happen on the CRMLS, because it's a bit more complicated than a single document. Awesome. Anybody else have any questions for Elijah before we let him jump in? And Elijah, I'm going to play timekeeper here for about 10 more minutes after this, if you have anything pertinent that you'd love to cover or data for us. Anybody else have any questions?
It was a lot of information. Do you guys want me to do a little bit more, or should we just explore more what we've already talked about? Because
I have a question, actually.
Yeah, what's up, man?
Yeah, you mentioned that you think that interest rates are going to decrease towards the end of the year. Why is that?
Good question. So there's really just one thing that makes interest rates go up, and that's inflation. Why? Well, you got to think about what happens on Wall Street. When you buy a government bond, that bond is good for 30 years. You're buying a loan. Whenever someone buys a property, it's packaged, put together, and sold on Wall Street as a mortgage-backed security. So if you buy that bond on Wall Street for the next 30 years, you're going to get the exact same payment. For illustrative purposes, let's just say that you get $1,000 a month. There's nothing that's ever going to make that payment change unless you have inflation. We have the worst inflation we've had in the last 40 years, with inflation going up 7.5%. So if inflation went up 7.5%, that $1,000 is no longer worth $1,000. You just lost $75 in value. So when people see inflation, they start selling all of their bonds, getting rid of them, because they don't want to be the first ones to lose money, and the market starts to lose its value. The Federal Reserve has kind of been saving interest rates, because they really should be a lot higher, almost double, but they've been buying about $50 billion $50 million every day of mortgage-backed securities. So they're the biggest investor, but they have also announced that they're going to be pulling out on that. The thing that makes it go away is, how can you get rid of inflation? There's really only one thing that the government can do to get rid of inflation, and that's to raise the Federal Reserve rate. So because the Federal Reserve is going to be raising it, well, they did it today already, so they raised it 0.25%, and so that's the interest rates actually hit an all-time high this morning. And when the Federal Reserve at 2 o'clock made that announcement, the mortgage-backed securities have already started to recover. If we have 7 more coming our way, then we know that over the next 7 rate hikes that we experience, we can see interest rates to continue to improve. Really good question. Thank you.
So my understanding is that as you see deflation happening, you often see interest rates increase. We can only point to like very specific times where there was deflation and there was decreases in rates of mortgage-backed securities for that.
So when you look at the last 68 years, every time that we've had deflation and inflation, interest rates have always had the exact same effect with immediate results. So you may see that within the course of 1 to 2 years, you'll see an after effect, but an immediate recourse is that interest rates have an immediate reaction, because people who are buying these things, they have an immediate reaction on Wall Street. The only thing that can make things not go so well is if the Federal Reserve announces that they're going to stop buying mortgage-backed securities. So because they are the largest investor of bonds on Wall Street, that's having a big impact. And they kind of have, last week they insinuated they were not going to do that, and that's when interest rates went really high last week. But today they didn't have any of that language in their minutes.
Yeah, so my understanding is that as we're pulling out of this quantitative easing process, interest rates are supposed to continue to increase. And then the plan was to be completely away from quantitative easing March 1st, but that obviously didn't happen, and they've extended that by a quarter. So I guess I still don't understand, if we're pulling out of that, why would rates decrease?
It's a really good question. So this is actually a little unprecedented, because the Federal Reserve doesn't typically buy government bonds and raise interest rates at the same time. And that's why we thought in June or July is when this was going to happen. But because of what's happening in our current geopolitical system, with inflation just going so quickly, Federal Reserve had to take immediate action and stop inflation while still buying mortgage-backed securities. So that is a little bit unique, but it's also beneficial. And it's also, you have to realize that even though they stop buying mortgage-backed securities up front, they actually every 30 days earn about $80 billion of finite bonds because a mortgage-backed security is finite. Once it has been sold off, people pay off their loans. While the money that they make on those, they have been reinvesting back into mortgage-backed securities, which is an additional $80 billion a month. And so far, they haven't said anything about that. So as long as even if they were to stop with quantitative easing, on the back end, we do see that they are still buying and have been buying mortgage-backed securities through the back door, so to speak.
And then I guess my other question is like, well, if mortgages, there's so much less mortgages, why decrease interest rates when they can just continue to charge increased interest rates on like the secondary market as well?
It's a really good question. And it's really not that the Federal Reserve is doing this to help the mortgage industry. It's just a really great side effect of what's going to happen. And us being in the mortgage industry, we have a pattern that we're able to predict of what's going to happen. When we saw that inflation was at 7% in January, we knew that they had no choice but to step in. What's happening with our current chairperson is very similar with what we had with Alan Greenspan and the Federal Reserve chairperson of 1979, where they were both being ultra conservative, and then they just kind of were forced to play the hand of raising rates, even if they didn't want to, because they have to make a decision as a body. And so he got outvoted as expected, because you know where everyone's role is going to be. They're very vocal about where they stand. If you look at where everyone is, whether they're conservative or aggressive on this, you can predict what's going to happen. So what we predicted would happen over the summer, it happened a little bit sooner. Great question. Any other questions?
Do you follow Barry Habib?
I do. I love him.
Yeah.
So I was fortunate to have Barry Habib mentor me, and he certified me in mortgage-backed securities.
Yeah, he is who I follow. If you guys haven't followed the National Real Estate Post or Barry Habib, I recommend that you reach out and connect in that. That's a great way to get the sound bites you need for quick answers to your clients.
Yeah,
Perfect.
Actually, a lot of the slides that I have, he sent them to me.
That's awesome.
Awesome. Yeah, actually, and you asked for other questions, and we have one here in the chat from Sofiane. If I'm pronouncing that right, sir, sorry about that. Can you go ahead and jump in and ask your question, or would you like me to go ahead and read it?
Is that on bridge loans in different states?
Yeah, sorry, I've got my kid screaming in the background, so yeah, it's mostly on mute there. But yeah, just wondering, like, you know, a lot of these guys living here are seeing like their house is worth so much money now. Maybe they can retire somewhere in another state less expensive. So, you know, what do you do in that situation in terms of bridging them?
Cool. So as long as the property that we're doing a bridge loan in is in California, no problem. It's a brand new loan product. I just barely announced it 2 weeks. Brian really jumped on it, and we weren't even fully ready to offer it. I was just kind of letting people know what was happening, but it is fully up and running now here in California, and we just opened it up to 15 other states. Our intention is to be able to have it available in all 50, but for all of you guys who are California real estate agents, it works anywhere here for the listing. And then I am licensed in all 50 states, so if they want a loan anywhere in the continental US, I can help them with that as well.
Awesome, thank you.
You're welcome.
Does anybody else have any major questions? Because we're about at time, so I think I might end up wrapping it up, but I want to provide, we've had some really amazing dialogue, so I want to provide the opportunity for anybody else to engage.
Thanks so much. I was late, so I'm looking forward to reviewing the recording. Really useful information so far. Thank you.
You're very welcome. And if you guys have any material that you'd like me to address in the future, I mean, realistically, there's a lot I don't know, but what I do know, I'd love to share with my real estate agents. Something that is really important to me is that we have a reciprocal relationship where I'm just not taking business, but I'm actually giving business to you, and I'm helping you to grow your business. So whatever that may be, please let me know. I'd love to be able to assist.
I do have one last question, if you don't mind, only because I had to step out for a minute. If someone's getting a bridge loan between selling their property and purchasing the new one, and now they're remortgaging the house that they just purchased, are they paying closing costs twice? And if so, like, how much is that? I mean, are bridge loans cheaper than as far as origination fees and all this?
There is a 1% fee on the loan. So our bridge loans go up to 300,000. So the most it'll be is $3,000, and they don't pay that. It's added on the loan that they're buying with.
Okay, got it.
Awesome. Well, thank you guys so much for your time and your energy. I really look forward to working with you guys, and you have my contact information. I'll be sure to email all of you guys individually. If you want any of these information, just send me an email. I'll be more than happy to send it to you in a format you can share.
And thank you very much for joining us, Elijah. This is, again, something I do every Wednesday. And if you guys are interested in joining these kinds of calls, please feel free to let me know, and I'll make sure you get put on that, that weekly meeting and meetup time. I would love to go ahead and try to get those resources, Elijah, as well for myself, but also for anybody who might listen to the recording afterwards and might want to connect. Is the best way to just connect you guys via email and let you run with it? Or would you, is there something that we can distribute to the group, kind of post this call? After this call, I'll have a YouTube recording of this up for people privately.
And I'll just send it to everyone. So I got the email from Tim already, so I'll just reply all and give you guys all a copy for the Pismo and Fresno area.
That would be awesome, sir. We really appreciate it. Well, thank you guys very much for all of your time. I hope you had a great opportunity to meet Elijah, hear what his products were, hear where they see the market headed. I think it's incredibly valuable to be able to take that language back with us for our clients, for our listings, for our buyers. So thank you very much, sir. And I wish you all to have a fantastic day. Love you, and God bless. Cheers.
Thank you.
Thank you guys. Bye-bye.